The break and retest strategy is one of the most essential strategies in Forex. And before you go thinking this is just another video telling you to buy at support or sell at resistance, that's not what we're doing today. In today's video, I'm going to teach you a strategy I personally have spent thousands of hours testing and adapting, creating this set of rules that creates this strategy that is like having a cheat code for a video game. This strategy is like counting cards at a blackjack table. No, of course you don't win every trade. No one's capable of doing that, but just like counting cards at a blackjack table, what you do is give yourself an advantage. And that advantage over a long period of time is what creates consistent profits. It's what creates a winning percentage that can help you make massive returns over time. So if you want access to the exact rules and the exact adaptations that took me personally thousands of hours to perfect, if you want access to the strategy that helped me go from a struggling trader consistently losing money to a professional trader with consistent profits, then stay tuned through the intro and disclaimer. Before we get started, my name is Steven, your honest trading coach. If you could do me a favor, click that like button to help out with the YouTube algorithm. Click subscribe down below the video to the right-hand side because we come out with videos like this each and every week. Hit the notification bell so you are notified. And follow us over on Instagram at The Trading Channel. I'm gonna let the intro and disclaimer roll, and I'll see you directly afterwards to help you perfect the break and retest trade. Welcome back, traders. Okay, so let's go ahead and dive right into today's video, dive right into the strategy. What we're doing with this strategy is avoiding moments in the market just like what you see on your screen. Moments in the market where the market's consolidating. This consolidation can eat you alive if you're trend trading or trading breaks and retests of structure. And the reason is you might say, oh, we're in trend. Look at this big move up, right? I'm gonna buy because we're in trend. I'm gonna put a stop loss right down here and a target up here. And in consolidation, unfortunately, the market normally doesn't hit that target, comes down and it'll stop you out. And then you'll go, oh shit, we're going lower. Now I need to go short. You'll go short somewhere like right here, looking at this pullback, retest, waiting for the market to push down, but instead it comes up and clips your stop right here. You've probably seen this before in your own trading if you've tried trading breaks and retests or tried trading trend during periods of consolidation. So the first step is to avoid moments like this. What this is going to do is give us a higher winning percentage, which overall means a larger profit by the end of the year, by a large number of trades. And so the way we do this is what I'm going to explain to you right now. I'm going to explain that to you in this strategy. But before we look at the strategy itself, let's take a look at a couple of trades we had in the EAP Training Program last week using a very similar strategy to this break and retest strategy, so I can explain the strategy to you, give you an overview, and then we'll dive into the exact rules directly afterwards. Let's take a look at those trades now. So on the screen right beside my face, you can see a trade on the dollar Swiss. This trade was based on the break and retest strategy I'm teaching you throughout this video. And let's go ahead and go look at how that trade played out. Now, if we just scroll the chart over a little bit, this was actually that trade right in this area. So what were we looking at here? Let me do a very quick overview of the entire strategy, and then I'll break down the rules a little bit more so afterwards. So with this strategy, what we're looking at is we want to see a market in a volatile trend. How do we define a volatile trend? Well, for me personally, I define a volatile trend as a market trading under the 20-period EMA, exponential moving average. So if we're trading under that 20-period EMA, then I'm defining that market as in a volatile downtrend. If we're in a volatile downtrend, then that's when I want to start looking for these break and retest trades. So let's go ahead and go over these rules. Again, don't get confused. This is going to be a very fast overview, and then I'm going to go through the rules slowly so you can completely understand it. But what I'm looking for essentially is a market trading below our 20 EMA, pulling back to it, getting pushed off that 20 EMA, and breaking the previous level of support. At that point is when I know I'm in a position to have the best possible chances of winning a retest trade. How so? What I mean by that is now is when I'll be waiting for a retest of this level right here. If I have this whole situation happening, market was trading under the 20 EMA, market pulled back to the 20 EMA, market then broke the previous level of support, that's when I'm ready to start looking for the retest and an entry reason for the market to go lower. Because through the thousands of hours of testing that I've done and historic data, what I've realized is that this is one of the most accurate ways to trade that retest, is having a market below the 20 in a volatile trend, pushing off the 20, breaking the previous level of structure and retesting it. At that point is when I want to start looking for trades. I'm going to show you one more example of this right now on the screen. This is a trade on the Euro Yen based again on the same exact rules that you're about to learn. So on this Euro Yen, let's go ahead and take a look at it, and I'll pull up the chart and we can look at the trade itself. In this specific scenario, we had a market that was pushing down. We're trading above the 20 EMA here, right? The red line on the screen is the 20 EMA. We have a push off the 20 EMA, pushing this market much higher. We then pull back into our previous resistance level. When we get back into that previous resistance level, I got a trade entry from right around in here, entry. I had a stop loss right under this level and a target right back up here at previous resistance, just like you see in the picture or saw in the picture a second ago. So that's using the same exact system. Now what I want to do is break down the rules themselves, look at a few examples, and get you to a point where you can master this type of trade, which can give you an edge over the market and provide those consistent profits we were talking about earlier. So let's take a look at some examples of this and go through the full rule set right now. All right, so let's go ahead and talk through the rules. What I'm looking for, I'm gonna have this red line is the 20 EMA. Price will be in blue. What I want to see price doing is trading above the 20 EMA, creating a high. And for a swing high, I have very simple rules for swing highs and lows. A swing high is a high that was previously had 2 green candles and afterwards has 2 red candles. At that point, this is a swing high. For a swing low, my rules for that are the exact opposite. Price coming down, I want to see a low that had 2 red candles before it and has 2 green candles after it. At that point, this is considered a swing low for me. What I'm looking at is these swing highs and lows, and that's what I need to see broken. So in this case, I would need price to be pushing above the 20 EMA. Then I would need to see price create that situation where we have a swing high with 2 green candles before it, 2 red candles after it, and then I need price to be bouncing off of the 20 EMA and breaking that swing high. If we do this, if we bounce off the 20 EMA, showing me we're in a volatile trend, we break above the previous high, at this point, what I'm waiting on is a pullback to that previous high, which I define as between the wicks and the body of that previous high. I'll show you that on a chart in just a second. But what I'm looking at now is this market to pull back into that level and give me an entry reason to head higher. Again, this is going to give me that best possible trade setup. It does take a lot of patience, which is involved in trading, but this gives me the best possible accuracy on break and retest trades, at least from the thousands and thousands of hours that I've spent studying this type of trading strategy. So this is what we're looking for a bullish trade. Let me go through a bearish trade, and then we're going to take a look at some examples and some more specific rules in just a second. Let's do a bearish example right now, though. Okay, same thing here, guys. Blue is going to be price. The red line's the 20 EMA. For a bearish example, I would need price to push below the 20 EMA, come back, test it, and be pushed off the 20 EMA, breaking the previous swing low. Once that happens, I need price to come back to that previous swing low and give me an entry reason. Once that happens, I'm ready to place that trade. It's going to give me that best possible trade setup for a break and retest trade because we're going with that volatile trend. And using these rules, we're staying out of consolidating markets, increasing winning percentage on any break and retest strategy, no matter what entry reason you use or targets or stops you use. And that is something that you can use in order to create consistent profits over a long period of time. So we've done a bearish example and a bullish example. Now we're going to take a look at some charts, and I'm going to explain these rules in a little more detail using actual charts. So let's head down to a chart now. Okay, so here we are on the euro dollar. And as you can see on this chart, price has been a bit choppy, right? Price has been consolidating here between the areas around 1.14 and around 1.118. Between these two areas, price has just been going back and forth. We haven't really seen any big moves out of these areas. And what I want to do is give you an example of how we keep ourselves from getting into trades during these periods of consolidation with just the rules that I've shared with you so far. So let's take a look at that. Here, in a bearish direction, we have a push down, push back up, push off the 20. When we pull back up to our zone here, do we get an entry reason at all? No, we do not. So we just keep looking for that optimal time to place a trade with a break and retest strategy. We then pull down, 2 candle up, that makes this a swing low. We need to see a break of this. We don't, we get this new low. We need to see a break of that. We finally do get a break of that. And in our zone, we get this huge red candle, but that's a massive candle. I wouldn't be taking a sell down here at the previous lows. So that would not have been a trade. We then push up, push back down, push up. Do we ever get that test of the 20, push up, break and close above resistance here. No, we don't get that at all until about right here. We get the break and close above, we get a pullback down, we get a green candle. Not a good entry reason though. And what we're going to use in this example for an entry reason is going to be a shooting star candle and a hammer candle. So in this position, this period of consolidation on the euro dollar, what we've done is avoided losing any trades during a consolidating market, which is going to again increase the accuracy of any trend continuation strategy. So now that we've looked at an example of how we stay out of trades in consolidation, let's look at examples of this exact set of rules at work. So right here, I already see a good example of this. We're going to be pushing above price. Price needs to be above 20, right? 20 EMA, red line. Price needs to be above it. So let's just look here. We get a push up. What do we need for a swing high? It needs to have at least 2 green candles before it, 2 red candles after it. Does this match those rules? Yes, it does. We get a pullback. We get a break and close above this level about right here. So what we have here, pullback, break and close above, we get a pullback into our zone and a nice candlestick pattern for entry. Stop below the swing low, targets wherever you'd like to put them, 1.5 risk reward. We're going to continue doing this. I'm just going to show you how this keeps you out of consolidation and can help you to get a more accurate strategy based on trend continuation. As we push up higher, we're looking for that next swing high that has at least 2 red candles going down. We have that right here. So this would be the swing high. We get a break and close. We get a pullback, but that pullback doesn't get back to our zone, so we have nothing there. We then get another move up to our next swing high, 2 red candles coming down, the pullback, the break and close. Now we're coming back into our zone, right? When we come back into our zone, we get this nice hammer candlestick. At that hammer candlestick, I'm gonna go ahead and give you an example of exactly how I'd be placing this trade. I'd be doing something like that. The hammer candlestick has an ATR of 37. So if I have 27 here, I want to add 37 pips to that because I want it to be a 1 ATR below the swing low stop loss. So let's do that math quickly. It's 57 plus 7, which would be 64. So we have a 64 pip stop. And with a 1.5 to 1 risk reward, like we just talked about, we hit those targets pretty easily. So that's an example of how to use the strategy itself to win a trade in this example again. As we talked about earlier, of course, no strategy is going to win all the time. What we're trying to do, though, is create an advantage where out of 100 trades, we can be profitable, maybe even excessively profitable, very profitable out of 100 trades. And then if we can get 100 trades every 6 months, we can find a way to be consistently profitable as traders, and that's how you start a professional trading career. So here was an example of a bullish trade using exactly what I've taught you in this video. Let's look at a bearish example, and then we're going to do something kind of special. I'm going to back test this with you over a period of time, maybe like 3 to 6 months, and we're going to see how it performed over the last 3 months on a currency pair that I'm going to randomly pick from the right side of our screen. So let's go ahead and look at one more example. Let's look at bearish, and then we'll do that. Okay guys, here's an example of a bearish version on the 1 hour chart on the New Zealand dollar, just showing you can use this on any time frame. I say use, take that back. Do not use this. Go test it on other time frames. Figure out if it's something you want in your trading plan and go from there when it comes in terms of creating a trading plan around it. Do not go out and just use this blindly. You will lose money. Forex has a substantial amount of risk. That risk is increased dramatically if you don't put in the work you need to, which testing a strategy is part of the work you need to. With that said, see if you can spot the trade, the strategy we just discussed on the New Zealand dollar right now. Hopefully you were able to see this. We have a market trading below the 20 period moving average. We have a push up to the 20 period moving average. And what do we need now? A break of that previous swing low. We have a break of that previous swing low followed by a pullback into that area and a shooting star candle right here. And in case you're wondering, the exact rules I use for a shooting star and a hammer candle, I don't call them that. I call them 33.3 candles because all I need to see is a candle that has a open and close in the lower third for a shooting star, or an open and close, the full body of the candle, in the top third for a hammer, a bullish candle. And what that means essentially, and what a very easy way to do that is grab a Fibonacci retracement, go from the high of your candle to the low of your candle. If the entire body of that candle is below 33.3% of the entire length of the candle, then I count that as a shooting star. Opposite for a bullish hammer. Now let's look at how we would have placed this trade. Remember, the close of that candle is going to be the entry. We will then take a look at our ATR of that candle, which is 17 pips. So we want to be 17 pips above the high of that candle. With that being the case, we have 7. Let's do the quick math. Plus 10 would be 27, minus 3 would be 24. So we have 24. We're going to be trying to look here for about a 1.5. And we get a 1.5 to 1 risk reward right here. So this would be another example, a bearish example of using this type of strategy in order to capture volatile trends and using this entry reason in order to place trades in the market with a stop and a target, exactly as I just described. Take it, test it, do what you will with it. What I'm going to do right now is give you an example of actually back testing this for about 3 months. Let's take a look at that right now. So first off, let's take a look at a full overview of the strategy itself. This was a trade we had at about 3 o'clock today, and let's go ahead and look at it, look at the chart. Tell me, can you see where this trade took place? Remember, for this strategy, we're looking for a market to be trading above the 20 EMA. We want to see a pullback to the 20 EMA, and we want to see the creation of a new higher high. When we get that new higher high, so for example, at this point right here, what we're going to do is create an area between the wicks and bodies of that high that was just broken. This is a break and retest strategy after all. And then when the market gets back into that area, we're waiting to see if the market prints a candle that looks very similar to this. Do we get a hammer candle? In this specific case, we did. And as you can see, the market took off to the high side in terms of placing this exact trade. Once I get that hammer candle, what I like to do is just place an entry on the close of that candle and a stop loss below the low of that candle by 1 ATR. So we're on the 5-minute chart. We're gonna have a very small ATR of 8 pips. Right here, we're sitting at 4. 4 plus 8 is going to be 12. So we have a 12 pip stop. And for a target, I like to use a 1.4 to a 1.5 to 1 risk reward. As you can see, this market took off and hit that quite easily earlier today. So this is an example of one that happened really recently, 3 o'clock today, and just a full overview of the exact strategy. Remember, trading above the 20 EMA, pulling back to the 20 EMA, creating new highs. Here's our zone. Waiting for the market to get back in that zone and create that entry reason candle. So that's a full overview. Let's go ahead and hop back to the rest of the video. All right, traders. So after realizing that this video itself is already over 15 minutes long, I've decided to do something else. What I'm going to do is that if you want to see a video dedicated to me back testing the exact strategy you just learned, and you want that video to be about that and how to back test in general, then I would love for you to go ahead and leave me a comment below. If I get over 50 comments about this subject, then next week's video will be a video on backtesting. It'll be completely dedicated to that subject. It's one of the most important subjects in your trading career. It'll be the most important thing you learn how to do is test a strategy through historical data. If you want to see that, comment below and let me know. For any of you who are interested in some more advanced training, we have a full arsenal of strategies just like the one you learned today that are easy to follow, simple to understand, and that have provided an edge over the market over the past. So if that's something you're interested in getting, a full training course, we have that available in the EAP Training Program. It's the top link in the description. We don't just have strategies in there though, because that's not all you need in order to be a professional trader. In that course, we will also be teaching you how to become a professional trader and build your own trading plan, your own profitable trading plan. So if that's something you need help with, I would love for you to be a part of our VIP team. The program also comes with 3 to 5 email alerts like you saw at the beginning of this video on the dollar Swiss and the euro yen each and every week. And on top of all of that, we also offer what's called priority email, which means if you have any questions about Forex in general or about the course material, you can email priority email and I will be the one personally responding to you about those questions in a very timely manner. So again, if that's something you're interested in, top link in the description right below where you're watching right now, right below the video. And if not, that's totally fine too. No big deal. Just make sure you're subscribed here because we do content like this each and every week. You want to click that notification bell so that you're alerted when it happens. Click that like button for me if you enjoyed today's content, and I look forward to seeing you guys again next week. Talk soon.